You're listening to this article from Convertz.app. What is DeFi? A beginner backslash. The big idea behind decentralized finance. Imagine a financial system where you do not need a bank to save money and earn interest, a broker to trade assets, or a loan officer to approve a loan. Instead, these services run automatically on computer code that anyone can use, anyone can inspect, and no single entity controls. That is decentralized finance, or decentralized finance. It is an ecosystem of financial applications built on blockchain technology, primarily Ethereum, that replicate and expand upon traditional financial services without intermediaries. How decentralized finance works. The foundation. Smart contracts. At the heart of decentralized finance are smart contracts, self-executing programs stored on a blockchain. A smart contract is a piece of code that automatically executes when predefined conditions are met. For example, a lending smart contract might say, if user A deposits 10 Ethereum as collateral, they can borrow up to $15,000 in stablecoins. If the value of their collateral falls below 150% of the loan value, automatically sell their Ethereum to repay the loan. No bank employee reviews the application. No committee approves the loan. The code runs on its own, 24 out of 7, for anyone who meets the conditions. Blockchain infrastructure. Most decentralized finance protocols run on Ethereum, the blockchain that pioneered smart contracts. However, high transaction costs on Ethereum have driven growth on Layer 2 networks, Arbitrum, Optimism, Base, built on top of Ethereum for lower costs. Alternative blockchains, Solana, Avalanche, BNB Chain. The choice of blockchain affects costs, speed, and which decentralized finance protocols are available. You can track the prices of these blockchain tokens on Convertz.app's crypto section. The main decentralized finance applications. Number 1. Decentralized exchanges, DEXs. What they do? Let you trade cryptocurrencies directly with other users without a centralized exchange like Coinbase or Binance. How they work? Instead of a traditional order book, most DEXs use automated market makers, AMMs. Users deposit pairs of tokens into liquidity pools, and an algorithm sets prices based on the ratio of tokens in the pool. Key protocols: Uniswap, SushiSwap, Curve Finance, Jupiter, Solana. Example: you want to swap Ethereum for USD coin. Instead of placing an order and waiting for a buyer, you trade directly against a liquidity pool that holds both Ethereum and USD coin. The swap is instant and handled entirely by the smart contract. Number 2. Lending and borrowing. What they do? Let you lend your crypto assets to earn interest or borrow against your crypto holdings. How they work? Lenders deposit assets into a pool and earn interest from borrowers. Borrowers deposit collateral, typically 150% or more of the loan value, and can then borrow against it. Key protocols: Aave, Compound, MakerDAO. Example: you hold 10 Ethereum and need cash, but do not want to sell. You deposit your Ethereum as collateral on Aave and borrow $15,000 in USD coin. You pay interest on the loan, and your Ethereum is returned when you repay. Number 3. Yield farming and liquidity mining. What they do? Reward users for providing liquidity or participating in protocol activities. How they work? Protocols incentivize users to deposit assets by rewarding them with additional tokens. This can include trading fees from decentralized exchange pools plus bonus token rewards. Key concept: annual percentage yield, APY, measures your potential return. In decentralized finance, APYs can range from 2 to 5% for stable, low-risk strategies to hundreds of percent for new, risky protocols. Higher APY almost always means higher risk. Number 4. Stablecoins. What they do? Provide a stable medium of exchange within the volatile crypto ecosystem. How they work? As covered in our stablecoin comparison guide, stablecoins like Tether, USD Coin, and DAI maintain a value pegged to the US dollar through various mechanisms. Stablecoins are the connective tissue of decentralized finance. They allow users to park value without exposure to price volatility and serve as the primary lending or borrowing asset in most protocols. Number 5. Insurance. What they do: protect against smart contract failures, hacks, and depegging events. How they work: users pay premiums to coverage pools, and claims are assessed by token holder governance or automated oracles. Key protocols: Nexus Mutual and Surace. The advantages of decentralized finance: permissionless access. Anyone with an internet connection and a wallet can use decentralized finance. No credit checks, no applications, no minimum balances. This is revolutionary for the estimated 1.4 billion adults globally who lack access to traditional banking. Transparency. All transactions and smart contract code are publicly visible on the blockchain. You can verify exactly how much collateral backs a lending protocol or how much liquidity is in a trading pool. Composability. Decentralized finance protocols can be combined like building blocks. You can deposit Ethereum on one protocol, borrow stablecoins, then use those stablecoins to provide liquidity on another protocol. This money Lego concept enables complex financial strategies. Non-custodial. You maintain control of your assets through your own wallet. No institution holds your funds, though the smart contract does during active use. Always open. Decentralized finance operates 24 out of 7 or 365 with no holidays, no closing hours, and no geographic restrictions. The risks of decentralized finance. Smart contract risk. Bugs in code can be exploited. Despite audits, decentralized finance protocols have lost billions to hacks. In 2022 alone, over $3 billion was stolen from decentralized finance protocols. Liquidation risk. If your collateral value drops below the required threshold, your position is automatically liquidated, often at a loss. Flash crashes in crypto markets can trigger mass liquidations. Impermanent loss. Liquidity providers on DEXs can experience impermanent loss when the price ratio of their deposited tokens changes. This can result in having less value than if they had simply held the tokens. Regulatory risk. Governments are increasingly regulating decentralized finance. Future regulations could restrict access, require KYC, know your customer, checks, or change the tax treatment of decentralized finance activities. No consumer protection. There is no FDIC insurance, no customer service hotline, and no way to reverse transactions if you make a mistake or get scammed. You are your own bank, for better and worse. Getting started safely. If you want to explore decentralized finance, start with these steps. Number 1. Learn before you invest. Understand the specific protocol you plan to use, not just decentralized finance in general. Number 2. Start with a small amount you can afford to lose entirely. Number 3. Use established protocols with long track records: Uniswap, Aave, MakerDAO, Curve. Number 4. Be cautious of high APYs. If a protocol offers 500% APY, something is likely unsustainable or very risky. Number 5. Use a hardware wallet for any significant holdings. Number 6. Never share your seed phrase with anyone or enter it on any website. The bigger picture. Decentralized finance represents a fundamental reimagining of financial services. Whether or not you participate directly, the innovations being developed in decentralized finance, instant settlement, transparent operations, programmable money, are increasingly influencing how traditional finance operates. Major banks and financial institutions are experimenting with blockchain technology and decentralized finance concepts. The line between traditional finance and decentralized finance will likely continue to blur. Disclaimer: this article is for educational and informational purposes only. Decentralized finance involves substantial risk, including the potential loss of all invested assets. Smart contract vulnerabilities, market volatility, and regulatory changes can all impact decentralized finance investments. This is not financial or investment advice. Always do your own research. That's the end of this article. Visit Convertz.app for more guides and free conversion tools.